Application fields of financial modeling. So we rarely use financial modeling to assets such as bonds, but for assets such as stocks, we see people use financial modeling, all the time. We see valuation metrics. They come up in newses, in YouTube. They come up everywhere. So why is that? So generally, financial modeling is used for investment situations or investment assets where future outcomes are difficult to predict. That's why we do financial modeling. If it's very easy to predict, we have no reason to apply this complex technique. And also for investment assets where investment time span is long term. That's also relevant to the difficulties in future outcomes, predicting future outcomes. Because if investment time span is short term, it's relatively easier to predict. Thus, no need for financial modeling. And lastly, when investment amounts are large, because when you're investing pocket money, it is very unlikely that we build a financial model. So, as a personal investor, as a retail investor like me, when I invest my stocks, of course, when I invest a lot of money, maybe as a financial modeling expert, I might do some financial modeling, but usually no, because simply it's not worth the time and putting in effort to base an investment decision based on financial modeling. So if we see the chart below, the higher the uncertainty, the bigger the investment amount, and lastly, the longer the investment time span, there's a much more high likelihood that we build a financial model. And in those cases, financial models tend to be more complex in their depths, and their length usually gets much more longer because you want to be as logical as possible. So it's not always this case. It's just a general idea on the relation between uncertainty and likelihood. The magnitude can vary by investment situation, but usually, for example, leverage buyouts, we invest in a long term. Usually leverage buyouts invest in 3 to 5 years. The investment amounts are relatively large because we're acquiring a whole company, and future outcomes are relatively difficult to predict. So leverage buyouts, in those situations, we build very complex, deep financial models. We do a lot of analysis, and analysts at private equity firms put in a lot of effort to doing it. Same for long-only funds. So long-only funds are also funds that invest in a portfolio of companies in the long term. They do a lot of research, a lot of studying, and long-only funds also build financial models that are relatively very complex and deep. Of course, venture capitals as well as private equities should build, because the outcomes are most difficult to predict, and their investment time span is also most likely to be long. But the reason I put likelihood below leverage buyouts or long-only funds is because for venture capitals, there's not much to analyze. So you need historical numbers, some historical performances in order to analyze and build a complex financial model. But for most startups, especially in seed stages or Series A or Series B, it's quite difficult to do a proper valuation. So that's why it's ranked below. But there could be some times or some situations where venture capitals require much more analysis compared to these two players. Again, this is just for explanatory purposes. And then we have financial planning and analysis. We have energy infrastructure projects. We have real estate. they're kind of in the middle. They're not as uncertain as, you know, stocks or these kind of situations. Thus, their financial models are relatively simple compared to ordinary stocks, but we do need to understand the industry, so there's still lots to study if you want to do financial modeling for these two asset classes. But still, if you have understood how to do proper modeling of ordinary stocks or leveraged buyout situations, I've seen students apply it to these asset classes relatively easy, so that's why we're starting with analyzing stocks in our Financial Modeling 101 and 201 classes.